Hi, Else here, and today we'll be talking about accrued expense adjusting entries and their impact on the accounting equation. What are accrued expenses? Well, accrue means to increase, gather together, or pile up. Expense means a cost you've had to get something or go somewhere. So an accrued expense means to gather together the costs in the business which we have not as yet recorded or paid at period end. So, at period end, what are we going to do about these costs that we've incurred but not recorded or paid? Costs incurred means we consumed or used something, so we have to expense it. Not paid means we owe somebody, so that's a liability. At every period end, we'll recognize the expense that is incurred but not recorded and the liability that is owed because we consumed something without paying for it yet. Let's do an example to solidify our understanding and actually see the entries that impact the accounting equation. ABC Company earned income before taxes of $55,000 this year. The company is charged a tax rate of 20% of their income. ABC Company records their adjusting entries at year end, and their year end is December 31st. No taxes have been recorded or paid this year. On February 28th of the following year, the company pays their outstanding income taxes. What entry, if any, do we have to make at December 31st? What did we incur on December 31st? We incurred a cost because taxes are a cost of earning income. Incurring a cost means we have to record an expense. So how much of a cost did we incur? Well, $55,000 times 20% is $11,000. So we have to record an expense of $11,000 at December 31st. Why? Because we've incurred a cost. This cost is unpaid. So do we owe someone? Yes, we owe Revenue Canada for the taxes we've incurred on our income, but not paid. That means our liabilities increase by $11,000 under the account called income taxes payable. Note, is this an adjusting entry? Yes, it is. How do we know that? Well, this is an internal transaction. Revenue Canada didn't send us a bill, and they didn't come knocking at our door. We have to record a liability because we know we owe it. And to make sure our liabilities are properly stated at the period end, or the year end, we have to record what we owe, but have not as yet paid. It's an adjusting entry because it's made by the company to recognize that something has been consumed, used, or incurred, but not yet paid. Now, let's fast forward to February 28th of the following year. We're standing in February 28th, that date. What are we going to do? Well, we're going to pay our taxes. How much? We know that we have to pay $11,000 in cash, so cash goes down by that amount because we've paid it. Now, what's the other side of the entry? A lot of students say that because we paid cash, the other side of the entry should be an expense, but that would be totally wrong. Why? Because we did not incur more expenses than we have already recognized at December 31st. Remember, last year at December 31st, we recognized income tax expense of $11,000 already. We did not incur in other costs, so we can't record an expense again. So, what's the other side of the entry? Remember that at December 31st, we recorded an income tax payable, a liability of $11,000. That liability is still sitting in the account. We've paid our obligation at February 28th. So, do we still have a liability? No, we do not. And so we have to recognize that we paid our obligations, and we have to get rid of the liability because it's been settled and we no longer owe anything. The other side of the entry is therefore a reduction in the liability account called income taxes payable to recognize that we've paid it off. What type of entry is this? It's a transactional entry because it's an exchange between two parties. Plus, it involved cash, and we know that whenever cash changes hands, it's a transactional entry. It's also an external transaction because it's an exchange between two parties involving cash. External transactions are always transactional entries. Now, let's look at both entries together. Remember that the first entry is an adjusting entry made at the end of the period or year. It's an internal transaction recording the fact that the company incurred a cost that they have not as yet paid, so they have to record an expense because we incurred a cost and a liability because we owe cash in the future. In the following year, when we actually pay cash, we have to do a transactional entry. Remember that this is an external transaction because we paid cash to an outside party, and our liability decreases because we don't owe anyone anything anymore. What's interesting about accrued expense adjusting entries compared to prepaid expense adjusting entries? Well, prepaid expense adjusting entries start with a transactional entry sometime during the year, and then they do an adjusting entry at the end of the year to recognize something that has been used or consumed. Now, accrued expense adjusting entries do an adjusting entry at the end of the year to recognize something that has been incurred but not as yet paid. Then we record a transactional entry after the year end to recognize paying off our obligations. Let's see that difference side by side. Prepaid expenses start as assets going in and out using a transactional entry, and they end with an adjusting entry recognizing an expense. Accrued expenses recognize an expense and a liability using an adjusting entry, and then have a transactional entry in the following year to get rid of the obligation and flow out the cash. Both of these have transactional entries and adjusting entries. Both adjusting entries happen at year end, but the prepaid has a transactional entry first, whereas the accrued expense has a transactional entry last, in the year following the adjusting entry. Keep this in mind when you're working on adjusting entries and trying to decide what entries to make first. So, that's it right now for accrued expense adjusting entry. In our next video, we'll be focusing on accrued revenue adjusting entries.